Hello fellows, welcome to my channel. This channel is entirely dedicated and created for educational purposes only. Here you can find high quality educational materials to learn the basics, whether you are a beginner, more advanced or an intermediate trader. For people that want to see more action, you can check the link on the top right corner and also the Reddit community created for you. Here we are proving our methods with real accounts. We trade for several years and we show that it can be done profitably. You can subscribe as all profits go to our subs. You can find all the details about our accounts. However, since you are new in trading, using real money is almost forbidden. Practice will make you better, and do not expect fancy cars and fake promises. Trading is real challenging and the numbers are against you. You won't need any money to start and everything is totally free. For most of our videos, you will find a link in the description that will lead you into a more advanced version of the video, but as beginners, I do not recommend. Stay with the basics and demo trading. So let's begin your journey. Why trade Forex? What are the advantages, if there are any? This is the reason we created this episode, and we will learn all the information. In my opinion, Forex market is the best. It's a market that cannot be manipulated due to its size, and let's say that we all have the same information and weapons to compete. There are many benefits and advantages of trading Forex. Of course, trading the market is very risky. Remember what we said about the numbers and how the market cannot be predicted so easily. Here are some benefits from trading Forex. There are no commissions. No clearing fees, no government fees, no exchange fees, no brokerage fees. Most retail brokers are compensated for their services through spread. If you are following our series, I'm sure you already know this information. There is no fixed lot size. In the futures market, lot of contract size are determined by the exchanges. For example, a standard size contract for gold future is approximately 3 kilos. In Forex, you can trade smaller position size. This allows traders to open trades as small as 1000 units. Using leverage, you can open a trading account with just 100 USD with very low transaction costs. The transaction cost is less than 0.1% under normal market conditions, and for larger transactions, the spread could be as low as 0.07. Of course, this depends on your leverage, and all that will be explained later. A 24-hour market. There is no waiting for the opening bell. From Monday opening to Australia to Friday afternoon in New York, the Forex market never sleeps. There are always opportunities to trade, no matter the country and the time you choose. This allows you to trade on a part-time basis. Remember what we said about starting with demo accounts. So, this is your time to shine. You can choose when you want to trade. Morning, noon, night, during breakfast, or in your sleep. No one can mess with this market. The FX market is so big that no one can manipulate this market. Of course, there are huge events that we will explain later in our series that you should pay attention to. There is no single entity that can affect the currency markets. The foreign exchange market is huge and has many participants that no single entity can control the market price for an extended period of time. Not even a central bank. By using a small deposit and by using leverage, you can start with an account as small as 100 USD. This is what we did in our series, trading the same real account to prove that it can be done for several years. Keep in mind that you should not open a real trading account until you become familiar with the idea, and make sure you can cultivate some good and profitable habits by using paper trading first. Leverage gives the ability to make some nice profits, but also the opposite. Remember what we said about leverage. Cuts from both edges. A Forex leverage 50 to 1 enables a trader to buy or sell 2.5k worth of currencies by using a simple 50 USD account. As we explained, leverage is a double-edged sword. Without proper risk management, this high degree of leverage can lead to large losses and to losing your entire account in a couple of seconds. Forex market has huge liquidity. With a click of a mouse button, you can instantaneously buy and sell at will in the price you want. You are never stuck in a trade. You can set your online trading platform to automatically close your position once you desire profit level, or close a trade if the trade is going against you. Remember the type of orders we explained in previous episodes. There are very low barriers to enter the market. Getting started as a currency trader would cost a ton of money. The fact is, when compared to trading stocks, future or options, it doesn't. Online forex brokers offer mini and micro trading accounts, so with a minimum account deposit of 50 USD, you can start an account. Again, do not attempt to open any real account. The market is not your friend, and you will need a lot of time and practice to get there, and that's why we are here. There is free stuff everywhere. Avoid paying lessons, as most of the information are free. Our channel is one example. Theory is totally free, and most of paying online courses offers generic information that can be found anywhere. You can open a demo trading account and get the experience of 1000 lessons in a day just by using paper trading. That it's totally free. And that's why Forex is awesome. Forex versus stocks. There are approximately 3,000 stocks listed on New York Stock Exchange, more than 3,000 on Nasdaq, and I'm not mentioning other major stock markets around the world. Which one will you trade? You think you will have time to stay on top of so many companies? You will just hear generic news from some parrots that try to manipulate the market and make you dive into the trades. Of course, trading stocks can also be profitable, but we are trying to make a comparison here. With Forex, there are also many currencies, but the majority of market players trade the 7 major pairs. Aren't 7 major pairs much easier to keep an eye on than thousands of stocks? Well, of course, this has to do with the personality of the trader, and the concept of trading can vary from trader to trader. In this series, the information is very valuable whether you trade stocks, commodities, crypto, or any other market. The stock market is not a 24 hours market. For example, the US most exchange open at 9:30 and closes at 4 p.m. The Forex market is a 24 hours market. Most brokers are open from Sunday until Friday with customer service usually available 24/7. With the ability to trade during the US, Asian, and European market hours, you can customize your own trading schedule and what is the best time for you. Commissions are minimal. Most Forex brokers charge no commission or additional transaction fees to trade currencies online or over the phone. Combined with a fully transparent spread, Forex trading costs are lower than those of any other market. Most brokers are compensated for their services through spread, higher trading volume and liquidity. The Forex market sees an average daily turnover of almost 7 trillion. The stock market sees just a fraction of this. Size does matter. Short selling is always an issue. There is no restriction on short selling in the currency market. Trading opportunities exist in the currency market regardless of whether a trader is going long or short. Since currency trading involves buying one currency and selling another, there is no directional bias to the market. So you always have equal access to trade in a rising or a falling market. There is no market manipulation. How many times have you heard that this person or the other person did a statement for a particular stock or company and affected the prices? Also, the stock market is very sensitive to large fund buying and selling. Due to the massive size of the Forex market, no one can affect the market. There is no fund or bank controlling a particular currency. There is no single entity that can affect the market. Governments, banks, hedge funds, large net worth individuals are just some of the participants in the spot Forex market. The liquidity is massive. Analysts and brokerage firms cannot influence the market for their own interests. Of course, we are still in the early stages, but in time we will see together how they try to manipulate the market by using the news. I'm not mentioning the TV anymore as it is a dead organism, but now the game is in social media. Armies of fake accounts try to manipulate the news and affect events. A low capitalization market has no chance. How many times have you heard that stocks analyst of a firm accused for keeping its recommendation, such as buy when the stock was declining? It's a zero-sum game. We need buyers to sell and sellers to buy. It's the nature of these relationships. Of course, there are a ton of regulations, but there is always an answer to this. No matter what the government does to step in and discourage this type of activity, we have the same repeatable pattern. A great example are IPOs, a big chapter for both companies going public and the brokerage houses. The next chapter is Forex versus futures. It's similar with stocks. Liquidity again is the main issue. The future markets trades at 30 billion per day. Forex stands at 6.5 trillion. The future markets can't compete. The Forex market is always liquid, meaning positions can be liquidated and stop orders execute with little or no slippage, with exception to extremely volatile market conditions. It's not a 24 hours market, and what I mean by that, if important data comes in from the UK or Japan while the US future market is closed, the next day's opening could be a wild ride. Overnight markets in future contracts do exist, and while liquidity is improving, they are still thinly traded relative to the spot FX market. Commissions is the same issue here. The competition among spot forex brokers is so big that you will most likely get the best quotes and very low transaction costs in form of spreads. You are sure about the prices. When trading forex, you get rapid execution and price certainty under normal market conditions. In future markets and equities, do not offer price certainty or instant trade execution. Even with electronic trading and limited guarantees of execution speed, the prices for fills for futures and equities on market orders are far from certain. The prices quoted by brokers often represent the last trade, not necessarily the price for which the contract will be filled. There is a guaranteed limited risk. With limitation in positions and margin call, your trades will be liquidated if required. This creates a safety that the account won't go negative. Traders must have position limits for the purposes of risk management. During normal market conditions, all open position will be closed immediately. In the future markets, your position may be liquidated at a loss bigger than you had initially in your account, and you will be liable for any resulting deficit in this account. I know it sucks, but this is how it's done. Thank you for watching this video. Go back, repeat the chapters you are not sure about, and subscribe to help us make more content. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content and trade safe.